Okay, quick question for you. Do you know the exact difference between saving and investing? Because, well, here's the thing. Most people use those two words interchangeably, like they mean the exact same thing, but they absolutely don't. And mixing them up, or using one when you really should be using the other, could quite literally be costing you thousands of dollars over your lifetime.
Welcome to today's Explainer. I am so thrilled you're tuning in. Today, we're breaking down exactly what each of these financial concepts actually means, when you should be doing which, and how to use both of them together to build real, lasting wealth. And we're going to do the whole shebang with zero jargon and zero fluff. Let's dive right in.
So here is our roadmap for today. We'll start with the core definitions, look at the case for saving, then the case for investing. After that, we'll cover two major money mistakes to avoid, break down the three-bucket strategy, and finally wrap up with some essential numbers you'll want to remember.
All right, starting right at the beginning with Section 1, the core definitions. Let's draw a clear line between these two financial tools.
The contrast between these two is honestly pretty stark. Saving is simply putting your money aside in a safe, easily accessible place, usually a bank account. Your primary goal here? Just to protect your money. It's stable, it's boring, and you know what? That is exactly the point. Investing, on the flip side, is putting your money to work in assets. We're talking stocks, bonds, real estate, or index funds. You do this with the expectation that it's going to grow over time. Notice I said the word expectation, not guarantee, because unlike saving, investing definitely involves risk.
Think of saving kind of like keeping an umbrella by the door. You don't expect the umbrella to multiply or suddenly turn into a bigger umbrella, right? It's just there, ready and waiting to protect you the literal second it starts raining. It is all about immediate safety and accessibility.
But investing, that is much more like planting a tree. When you plant a seed, it takes years of patience. It's got to weather some storms and changing seasons, but eventually, it grows to give you shade, fruit, and significantly more value than that tiny seed you originally put into the ground. Both the umbrella and the tree matter. The ultimate financial mistake is trying to use an umbrella to grow fruit, or trying to use a little sapling to keep the rain off your head today.
Which brings us to Section 2, the case for saving. We're talking preservation and short-term safety here.
So, when do we actually reach for that umbrella? Well, saving is absolutely the right move when you're going to need the money soon. Specifically, within the next 1 to 3 years. It's also your only choice when you simply cannot afford to lose that cash. The classic example here is your emergency fund. Financial experts largely agree you need 3 to 6 months of living expenses parked somewhere safe. And listen closely, this needs to be away in cash, ideally in a high-yield savings account. It should not be in stocks, and it absolutely, definitely should not be in crypto. Why? Because if you lose your job tomorrow, there is no way you want to be forced to sell your assets at a massive loss just to make your rent payment. You also use saving for known upcoming expenses, say a car you need next year, a vacation in 6 months, or a house down payment. The massive upside here is that this money is entirely liquid and totally safe.
But hey, there is a catch. And this is exactly why you can't just save everything. Even if you have a great high-yield savings account paying around 4 to 5% interest right now, that really only sounds okay on the surface. The hidden reality? Inflation is always eating into your purchasing power over time. Saving preserves your money. It doesn't really grow it. If you leave all your money in savings for decades, you are actually losing ground.
And that is a perfect pivot into Section 3, the case for investing. This is all about growth and long-term horizons.
Now, investing is where we shift from just preserving what we have to actually building wealth. But it's only the right move when you meet a few strict prerequisites. First, you know for a fact you won't need this money for at least 3 to 5 years. Second, you already have that cash emergency fund firmly in place. And third, you have the emotional readiness to stomach the short-term ups and downs. Because here's the honest truth about investing. In the short term, markets go up and markets go down. Some years are going to look really, really ugly. You've got to be prepared for that reality. So why even take that risk? Well, because historically, over long time horizons, the trend is overwhelmingly up. People are constantly trying to guess when the market will drop or rise, but the data is incredibly clear here. Time in the market beats timing the market every single time. It's about patience, not prediction.
And I want to show you exactly why that patience pays off. Think about this number for a second. $50,000. Imagine you invest just $5,000 today, and then you never touch it again. You don't add another dime. If that money grows at an average of 8% per year, which, by the way, is roughly what the S&P 500 has historically returned, after 30 years, your initial $5,000 turns into over $50,000. You didn't add a single dollar of your own money to get that extra $45,000.
That is the absolute magic of compound growth doing the heavy lifting for you. It's your money making money, and then that new money making even more money. Now just imagine what happens if you add money to that investment every single year. The numbers get crazy fast. This is how real wealth is built.
All right, moving into section 4, 2 major money mistakes. Let's talk about finding the balance.
Because out in the real world, people constantly misuse these tools. There are 2 extreme mistakes you absolutely must avoid. Mistake number 1 is only saving and never investing. You might have $30,000 sitting in a regular bank account because it feels safe. But as we just learned, you are quietly losing purchasing power to inflation every single year. Long-term safety actually requires you to take some calculated investment risk. Mistake number 2 is the exact opposite. It's investing before you have a financial cushion. A lot of folks hear that investing is how you build wealth, so they go all in on the stock market before they even have a basic emergency fund. Then life happens. The car breaks down, they have no cash on hand, and they are forced to pull their money out of the market. And if the market happens to be down that day, they lock in massive losses. The order in which you do these things matters completely.
So how do we fix this? Let's move to section 5, the 3-bucket strategy. This is a simple, repeatable framework.
Here is exactly how to sequence your financial life so you don't have to stress about those mistakes again. Step 1 is filling bucket 1, the safety bucket. This is your savings. Your 3 to 6 months of living expenses parked right in a high-yield savings account. It is boring, and you do not touch it unless there is a genuine, undeniable emergency. Once bucket 1 is full, you move to step 2, filling bucket 2, the goals bucket. This is short-term savings for specific things happening in the next 1 to 3 years. A trip, a wedding, a car. This also stays in safe, accessible accounts. Only after those are secure do you proceed to step 3, bucket 3, the wealth bucket. This is your investments, money you won't need for at least 5 years. You put this to work in index funds, your Roth IRA, or your 401k, and you let compound growth do its thing. Sequence is literally everything here. Bucket 1 first, then bucket 2, and everything beyond that pours into bucket 3. It's simple, and it works.
Let's bring it all home with our final section, essential numbers to remember. Here are your quick takeaways. 3 to 6, that is the number of months of expenses you absolutely must have sitting in your emergency fund before you even think about starting to invest aggressively. It is your ultimate financial shock absorber.
$7,000. That is the Roth IRA contribution limit for the year 2025, if you are under 50 years old. If you have the means, max this out. It's an incredible vehicle for your bucket 3 investments.
8%. This is the rough historical average annual return of a broad U.S. stock market index fund before factoring in inflation. It is the engine behind that incredible compound growth we talked about.
At the end of the day, saving and investing are totally different animals, but a strong financial foundation absolutely requires both. Save for emergencies and short-term goals to build your safety net, then invest for long-term wealth so your money can grow. The best time to start was yesterday, for sure, but the second best time is today. Even if you're starting small, the act of just starting matters far more than the initial amount. So, I'll leave you with this to think about. Looking at your own finances, are you more of a saver or an investor right now? Think about which bucket needs your attention next. And if you're ready to tackle that wealth bucket, keep an eye out for our upcoming explainer where we dive deep into index funds for absolute beginners. Until then, keep learning and keep building.